Good morning and welcome to today's webcast, ASU 2023-09 New Income Tax Disclosure Requirements. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves, and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you could read more about it on our website via the link in the slide deck and handouts widget. And with that, I will turn it over to Mayumi to get us started.
Thanks, Emily. Hello, everyone. Welcome to our webcast, ASU 2023-09, New Income Tax Disclosure Requirements. Today, we're going to talk about how this new accounting standard will change the way your organization's tax disclosures will look like and how you can prepare for those changes. My name is Mayumi Kelmpel, Tax Director here at Baker Tilly. I am also a member of the National Tax ASC 740 Practice Group, and I also work with clients in the financial services industry, including financial institutions, consumer and specialty finance, and fintech sectors. Joining me today are Dave Antoni, Managing Director in Pennsylvania, as well as Tim Rinehart, Principal in Pacific Northwest. I'm going to have them introduce themselves.
Thank you, Mayumi. My name is Dave Antoni, and I am a Managing Director in our National Tax ASC 740 Practice Group. My experience with ASC 740 lasts over 35 years, serving both SEC public as well as private companies for ASC 740 services, both from an audit perspective as well as a tax outsourcing perspective. My industries served over my 35 years include food and beverage, life science, manufacturing, retail and consumer goods, as well as insurance.
Thank you, Dave. My name is Tim Rinehart. I'm a principal, as Mayumi said, in the PNW region. I sit here in the Portland office. I've my specialty focus is in ASU 740 services. I serve a variety of companies in the technology, communications, media, and life sciences space. I've been practicing public accounting for over 20 years. Similar to Dave, I've worked in a variety of ASU 740, C Corp, and other corporate kind of functions, helping clients prepare income tax provisions, helping our audit teams deliver financial statement reviews, including income taxes and ASC 740 impacts. And very happy to be here and look forward to sharing our knowledge with you and discussing this accounting standard further.
So our agenda today is based on the ASU 2309 pronouncement that was released in December of 2023. That was put forward at the behest of investors and readers of financial statements for better disclosures in the area of a tabular rate reconciliation, as well as income taxes paid to forecast the amount of cash that is being utilized for tax payments, as well as improved disclosures in the footnotes. We are going to break our topics down with an overview of the ASU 2309 standard, covering policy elections, which this standard has potentially many policy elections, as there is flexibility built into the standard for how, as you'll see, different reconciling items are disclosed. So we will go through those typical options that we're currently seeing. We're going to have an example of a U.S. domestic public company applying the standard for 2025. We will then turn to a multinational public entity example showing foreign jurisdictions coming into play along with the domestic side. And then we will have an example for a non-public entity, so a private business entity. And these provisions for private companies will come into effect in 2026. We're going to try to leave at least 5 to 10 minutes for Q&A at the end. So continue to utilize the chat feature to post your questions, and we'll try to get those in those 5 to 10 minutes, or otherwise respond after the conclusion of the webcast. One very current recent event recently occurred on July 20th, when House Appropriations Chair Tom Cole released a summary of the fiscal 2026 Financial Services and General Government Appropriations Bill that includes funding for the SEC. And a statement is included in the summary that basically indicates that the House Appropriations Committee is concerned with the release of ASU 2309 in terms of the amount of additional disclosures that the standard requires. And they actually have language in there that indicates that the FASB budget will not be approved by the SEC until the FASB withdraws ASU 2309. So this is very recent, on July 20th. It's just a statement of their position. Nothing happens or changes at this point. We just need to all watch for further developments on this House committee bill for 2026. We're sure that there will be a lot of stakeholders that will weigh in and voice their position. It seems that companies are already implementing the standard, and so whether this really goes anywhere. So the rest of our webcast assumes that ASU 2309 continues for 2025. And we'll just wait and see what happens with this announcement in the coming weeks. Let's see. So we will have our first polling question. So how would you describe your organization that you represent? Do you represent a domestic public business entity, a multinational public business entity, a domestic non-public entity, a multinational non-public entity, a public accounting firm, or other? So please select your answers, and then we will see what the poll shows. So we got 75% of attendees. Let's see if we can get 100%. Okay, we're 87%. Let's see. I wonder. So let's see. 48.8% are domestic non-public entities. 15% are public accounting. Only 12% are domestic public companies. 6.3% are multinational. So it looks like the majority of the participants are from non-public entities. Interesting. Okay. So Mayumi.
Yeah, thanks, Dave. This is interesting. We got a pretty good mixture of participants today. So I'm going to cover first some high-level overview of the standard. So let's first note that the effective dates, I think we all know that, but dates of this ASU. So public business entities will adopt this standard for annual periods beginning after December 15th, 2024. This means that for calendar year issuers, this will be the first year, 2025 will be the first year that this ASU is mandatory. And then other entities will have another year to prepare. But we're going to share very important information for, non-public entities as well. So please stay tuned. And all right, little bit of a history here. So FASB tried to simplify the tax disclosures in the past, but this new standard will expand the tax disclosures and potentially make our jobs harder, especially if your company operates in a number of jurisdictions. And so Dave mentioned that earlier, but the reason for the change is because the stakeholders requested more transparency into the entity's taxes. So in 2015, FASB started this project and then issued a couple of different proposals, but those didn't gain traction then. And then because the investors and creditors didn't find those that useful. And then finally, in the middle of 2023, the draft version of the current standard came out. They collected additional feedback. In December of 2023, the standard became final. So as you'd notice, this has been around for over a year and a half at this point. So I feel like some of the audience may already have digested and, good to go. And some of you may need some refresher because it's been outstanding. It's been around for such a long time. And some may have not yet dug into this because the adoption was farther out. But this is a great time to talk about this because, on top of just this accounting standard change, we just had the OBBBA, One Big Beautiful Bill Act enacted, and then we're going to throw in some of the items during this presentation as well. So the two big changes to the income tax disclosures under this standard are to the effective tax rate reconciliation and income taxes paid, as Dave mentioned. So if you're a U.S. domiciled company, then you'd expect a corporate tax rate of 21%. But of course, there are other things that's gonna, hit the tax rate and make the effective tax rate lower or higher than the 21% tax rate. Historically, there was no specific categories or how to group these effects that the company had to follow. So it was a little bit hard to compare the two companies' rate reconciliation tables and understand what's going on. And the same with the income taxes paid disclosure, as it's been just one line item in a statement of cash flows with no additional useful information. So this standard would expand that, and it requires the tax payments to be disaggregated by Fed, state, and foreign. And if there are jurisdictions that accounts for 5% or more of the total taxes paid, then it needs to be further disaggregated. So we're gonna wanna kind of give you the visual of the old format rate reconciliation and then under the new standard. So we're looking at exactly the same information here, but as you can see, under the old standard, it is giving you some information about this company's profile. It looks like it's a multinational company. You have the global intangible low taxed income showing up. Probably there's foreign tax credits maybe in the tax credit category. But then the new standard would expand that and then provides a lot more information to the reader of the financial statements. So just wanted to provide this visual. We're going to come back to it as we're talking about the categories and such, but just to give you some flavor of the new standard here. All right. So the standard can be applied on a prospective or retrospective basis. And so if you're applying this on a prospective basis, then you'll have two differently formatted tables for the current year and in the two prior periods. So I was on the webcast on this topic earlier, and it seems like more companies are now considering retrospective application than we, tax or accounting people initially anticipated. And so it makes sense to me because, of course, having the similar formatted, like the same format table is a lot cleaner to present. And so to the extent the information is available and then it's easy to put it into the new format, it makes sense that more people are considering that option. And then the standard can be applied, you can adapt this early. And if you'd like to start using this format, it's permitted. And then on the last bullet point here, so now the new standard requires both the percentage and then the amount to be disclosed. I've seen some public business entities disclosing either the rate or amount to be disclosed in the rate reconciliation tables, but this standard now requires both the amount and the percentage to be disclosed. So if your table hasn't been formatted that way, you're going to need to add a column.
And Mayumi, I guess one additional point there is, although we're talking about public business entities, a non-public business entity, a private company, if it so chooses, it can utilize the new tabular expanded footnotes as well.
Yep. Yeah, that's right, Dave. And to add on to that too, for non-public entities, even if you don't include the tabular rate reconciliation, you'd still need to disclose. I think that's what Mayumi's going to cover here, but you still have the disclosure qualitatively, right? So something to think about.
Yep. Thanks for chipping in, guys, because that's going to be an important discussion point. So we're going to move on and talk about more under this new standard. So now all entities will need to disclose the pre-tax net income in the U.S. and foreign jurisdictions. And so this rule has been included in the SEC regulations. So public entities probably have been doing this, and then but SEC and the FASB talked about which body will ultimately keep this disclosure requirements, and it ended up in this FASB codification under the standard. So now all of the entities will need to include this information in a tax footnote. And then if you have not included it, actually, I forgot to talk about the income tax expense side as well. So now you're going to have to include the federal, state, and foreign tax expense disclosure, even if you are a private entity. And then so if you have not included this information in the financial in the past because you're a private entity, one way to achieve this is by incorporating this information into the current and deferred income tax table, I think that might be the easiest way to go about it under this requirement. So additional disclosures that apply to all entities. I touched on this earlier, but the income taxes paid, again, this is one of the biggest change to the standard. And you'll need to disclose the amount paid, this time net of refunds received by jurisdiction, and 5% disaggregation rule also will apply. I've seen some entities just showing the amount of income taxes paid in the past, but then this standard now changes to be net of refunds received. So you're going to have to change the approach if you've been just disclosing the amount paid. The standard also removed a couple of disclosure requirements. The first one is the range of change in unrecognized tax benefits in the next 12 months. It seems like this information didn't give a whole lot of useful information. So if you historically had a line item in that footnote saying, oh, we don't expect this item to change in the next 12 months, probably this is the time to remove that. The second item, although the new standard eliminated the disclosures related to the cumulative amount of temporary differences where no deferred tax liability is recognized due to the permanent reinvestment exception, entities will still need to disclose the description of the types of the temporary differences and the events that would cause the reversal to occur. And then so under this specific ASC code 740-30-50-2, this standard removed B, but then A, C, and D are still intact. So make sure which disclosures got removed. If you have this disclosure requirement in the past, make sure you're removing the correct thing and then keeping the required disclosure intact. And then,
yeah, so the main point there of importance is where you do not record a deferred tax liability because of the indefinite reversal criteria, the current standard remains, which is if you can reasonably estimate that amount, it's practicable to estimate, you would disclose it. So that still is a requirement, but again, the existing rule is if it's not practical to calculate the DTL, you don't need to disclose it.
Thanks, Dave. And then I see a question related to the income taxes paid. I think I can readily answer that question that's popping up at the top. So disaggregation of income taxes paid, would you further break down by state if the entity operates in multiple states? Yes. So if let's say you paid certain amount to, let's say, specific state, and then if that state taxes account for 5% or more of the total income taxes paid for that year, that information needs to be further disaggregated. So you would have, let's say, California, certain amount specifically disclosed in that table. Now, Tim is going to talk a lot more about the categories because this is the meat of the standards. So, Tim, go ahead.
Thank you, Mayumi. So, yeah, as we noted previously, so public entities are required to provide this updated tabular rate reconciliation disclosure. It's required to show both the amounts and the percentages. So really, the first step you'd want to take as you're kind of going through this and trying to break it out is you'll need to know, kind of what the threshold amount is, because some of these topics require further disaggregation. And so to know sort of what that threshold is for that disaggregation, you take 5% multiplied by the income, the pre-tax income over the income tax that's applicable to that national rate that you're dealing with. So if you're dealing with the U.S. domestic company, you'd use the 21%. It's just the federal tax, not federal plus state or anything like that. It's also important to know the guidance does not address whether the amount of these items is to be presented in comparative periods. And so you may hit the threshold in the current period and not a prior period. So there's some optionality there as to whether you will want to, disclose that amount in a 2024 year or 2023 year, or just put a dash there indicating not applicable. So as we go through this tabular rate rec, there's really 8 categories that are specified within the guidance that are required to be separately disclosed. So the first one is state and local income tax, net of the federal tax effect. This one has kind of an interesting specific disclosure related to it that requires that the company qualitatively disclose the amount of state taxes by jurisdiction, or the jurisdictions that contribute to the majority that are greater than 20% of the overall tax effect. Also, as you're thinking about what goes into this category, you would also include changes in the valuation allowance for state and local income tax. And you'd also have the optionality with regard to unrecognized tax benefits, whether to include the current build on a state uncertain tax position in that category. Typically, the unrecognized tax benefit category is aggregated for all jurisdictions. Certainly for anything that relates to tax positions taken prior to the current year would go in that last category. But for positions related to the current year, there is optionality both for the state impact and for the foreign impact to include those currently. So state taxes, interestingly, also, you would only want to include the state taxes that relate to the jurisdiction of domicile. So if you had state or provincial or other types of taxes that exist for your company, those would, if those aren't part of the jurisdiction of domicile, those would more likely go into the foreign tax effects category. Speaking of the foreign tax effects category, this is the one category that requires even further disaggregation by country and by nature. And so this guidance, as you apply it, you're going to want to first determine which jurisdictions meet the 5% threshold so that you can start disaggregating by jurisdiction. And then even if you don't have jurisdictions that meet that percentage threshold, you could still have disclosure amounts if there are items within that by their nature require separate that are separate reconciling items that would require disclosure. So it's sort of the items within the items. So again, you first want to break it apart by jurisdiction and then by its nature. And again, for unrecognized tax benefits related to the current year, those amounts would also go into that category. The next 5 categories relate to federal items, so the jurisdiction of domicile. And so interestingly, with the new the big beautiful bill, I think we will expect there to be something probably in that first category within that box, the effects of changes in tax laws or rates enacted in the current period. Domestically, a lot of those items are things like 174 and bonus depreciation, 163J. A lot of those are temporary differences, so they may not present in this rate rec just because they are temp differences. But you would also likely have things like GILTI and FDII and BEAD, some of the changes there that could present there. So you need to, as you sort of work through the big beautiful bill, you'll want to sort of think about how those items are going to ultimately get disclosed in the rate reconciliation at the end of the day.
Yeah, and I think one other item we were discussing as a group before is what happens if under the new tax law you are in a situation where your valuation allowance would come down because maybe your deferred tax assets are changing materially with, say, 174 not capitalized or 163J changes allowing for earlier utilization. Would maybe it's a policy election. Would any part of that valuation allowance change go in the change in tax rate, change in tax laws? Since maybe you could tie that valuation allowance change to the effects of the law, or do we strictly put all valuation allowance in the change in valuation allowance line? We just don't have any specific guidance that's addressing that point. And, so that's just something to think about when we're planning and how this is all going to look and what elections might you make. And we'll talk about policy elections.
Yep, that's right. And whatever policies that you choose to apply, the most important thing, of course, is to apply those policies and elections consistently. That's usually the number one thing that's looked for by regulators, is sort of the consistent application. Dave mentioned elections. I mean, within these categories too, there's elections to net certain items. Typically you report them gross. So for instance, like the tax credits category, you would report the gross credits. With respect to effective cross-border tax laws, you would reflect sort of the gross, FDII, guilty, beat amounts. These are amounts that are taxed items in your jurisdiction of domicile that relate to income that's outside of that jurisdiction. And so there's elections there where you could essentially reflect, those cross-border items net of foreign tax credits that are related to those items like guilty and such. Or similarly with tax credits that have uncertain tax positions, you could reflect those as sort of net of, the UTB. Thinking about valuation allowances, I mean, typically valuation allowances are broken apart. The state piece would go into the state category, the foreign piece would go into the foreign category. The federal domestic part would just stay within this, main category. So that's how you'd apply valuation allowances. And then for other items that are, like non-taxable or non-deductible items, you could end up with items that don't really have a clear place to land. Some of those things include excess tax benefits of stock options, where a part may be related to foreign and other parts may be more suited here, or you may want to put it, in other if it doesn't really belong, in either category. And so that's sort of this last point where, to the extent you have other items, you would want to further disaggregate by nature the reconciling items to the extent that they meet that 5% threshold test. And so just to sort of go back to the illustration, if we look at this again, we can see, how these foreign pieces are sort of broken out kind of by nature, by jurisdiction, and then by nature. And these other pieces related to domestic, like the tax credits, the R&D and such, are broken out sort of within the 5% threshold. And then we see other, the excess tax benefits big enough to sort of break it out on its own. So, I mean, to Dave's point, there are different elections to make, different policies, et cetera. So you'll have to make sure you think through all of those as you sort of proceed through the, putting together your disclosure. And then the last piece, just to highlight, if it's not evident by those disclosures, you'll also need to present a sort of a qualitative disclosure as to the nature, effect, and sort of significant year-over-year changes of those reconciling items. And as I said before, we want to think through what some of these policy elections we might want to apply. Before we get there, I think we have one more polling question. Yes. So to comply with the requirements of ASU 2023-09, does your organization expect to A, spend more time on income tax provision footnote prep, B, have no significant changes, C, A and B, or D, other?
I thought there was actually one more option when we were putting this together. There wasn't a question about if you're going to have a new software or some new technology. And then so A and B was supposed to encompass those two. more time spent and then maybe new technology, but it seems like we had a technical issue here. So some of you could answer other if you're thinking about software solution as well. So as we are waiting for participants to answer this question, I see another question popping up, and it is regarding how the prospective application works on 2025 disclosure. I've seen prospective application, early adopter presenting just the 2025 in a different format under this disclosure standard, and then the prior 2 years information is still the same as the old, like the older format. So you're going to have 2 different tables is what I've seen. Hope that answered your question. So it's not like, one table and then just you leave some items blank, but you're just going to have prior year tables the same, as how it had been reported. In 2025 looks different.
I guess we should move on. We got 89% and see what the answers are.
Yeah, it looks like overall the answer is spend more time on footnote preparation, which makes sense given the disclosure. 33% have no significant changes. A and B same or other. I'm not sure again what other means. All right.
Policy elections. So
off the date.
Yep. As Tim mentioned, entities will need to carefully consider which policies to select in your initial year of adoption. And this is why planning, getting started early, is so important. Even before we get close to year end, modeling your 2024 and 2023 from a comparability perspective, looking at your rate. And as we showed on that expanded footnote, there's a lot more categories now. And just to model, how is your current footnote for 2024 going to look like? And within these elections, these are just some of the elections that we've been able to identify going through the standard where the key word is may. So wherever you see in ASU 2309 may, then that gives you that optionality. And with any policy election, you want to carefully document your chosen method that you will follow consistently from year to year. So I think we covered most of these going through Tim's presentation, gross versus net presentation on unrecognized tax benefits, including the initial recognition of an unrecognized benefit in the category to which the gross tax position is recorded, whether that's an R&D credit, recording that net, or a state benefit net, or a foreign tax position benefit net of the unrecognized tax benefit. And as well as with the cross-border, with the case of, say, guilty, if you have a foreign tax credit, you can, in that case, net the foreign tax credit associated with guilty. That's a policy election as well. And then materiality considerations is how far do you search and dig for these different items as to which categories will your policy election apply to in terms of cutting off at a material level, the identification of the particular item. And as I think was mentioned, if you have that same item in the prior year, but that is, below that 5% threshold, you possibly may not choose to show that comparability if it's a very small number. And so all of that gets wrapped into your policy election. So you want to carefully document it, what you're going to plan to do with your disclosures. And then, as I mentioned, the prior year disaggregation of disclosures that cross the 5% in the current year, they're less than 5% in the prior year, whether you still put that number in or you call it, NA, or, put it in other for that category in the prior year. And then other things that we haven't talked about, share-based compensation, that normally maybe would be in other, but as Tim mentioned, if it's greater than 5% by nature, well, maybe share-based compensation would be a separate item. And RTP, where would that go? Potentially, if it's below the 5%, you might have a policy election to put that in other, or you may choose to break that up by the jurisdiction that it relates, what you would typically think from a federal, state, and foreign perspective. And then Pillar 2 not only has traditional foreign tax elements, but it has these top-up taxes. How do you handle those, and the effects on related credits? So these are things to be thinking about. In the area of investment tax credit, there is a sort of traditional, take the credit in the year that you earn it, but then there's also the ability to amortize. And so thinking about those disclosures. So in addition, non-public companies, which we have a lot on the webcast, are currently required to disclose the nature of significant reconciling items, but may omit a numerical reconciliation, as was mentioned. Private companies can elect to include the tabular reconciliation, but as Tim mentioned, they still would be required to provide the qualitative disclosures, including the nature and effect of specific categories of items in individual jurisdictions. And we have an example for a private company of that potential disclosure. So we have another polling question. So how has your organization considered policies regarding how to present or categorize items in the rate rec? So it's going to depend on how far along you are in this process. A, yes, you document it and implement it, those decisions. Yes, but you haven't yet documented and implemented. No, this was not on our radar. So maybe now you need to circle back and take a look at it further. No, we are not a public business entity, or other. So let's see how the results come in.
I hope if you're choosing, answer D, again, we've been talking about this throughout this presentation, but just because you're not public business entity doesn't mean that this standard doesn't apply. You're still going to have to look at the same categories and jurisdictions. So hopefully there's not a whole lot of a D here, but we'll see.
So we've got 483, it says, that can potentially ask the question. We're getting there.
I think so far 86% of the attendees answered the question. We're going to give you maybe 10 more seconds.
See if we get above 90%.
88% now. Okay. 5 seconds. All right. Let's move on, maybe.
All right. How has your organization considered these policies? Oh, 10% yes have documented and implemented. That's great. Yes, but we have not yet documented and implemented. 21%. No, this is not on our radar. no, we are not a public business entity, and other. So interesting results, not unexpected. Okay,
All right.
Mayumi.
Yep. So now we're going to look at some examples. So there are a couple of examples we picked. So we are showing domestic public business NED example, and then we're also going to look at the multinational example and also private entities disclosures. So first off, using this domestic illustration, we wanted to talk about the policies that David talked about, how it's going to change the presentation of your rate reconciliation. It's pretty impactful. So we wanted to talk about that using kind of like an extreme example. And then we also wanted to mention that, this is a relatively small rate reconciliation being domestic business entity, but they are still following different categories specified under the standard. So you're going to see U.S. federal statutory tax starting from 21%, and then you have a specific category. And then changes in unrecognized tax benefits line showing up here. So first off, if you're looking at this rate reconciliation, you might notice what is this tax credit, an item that's called low-income housing tax credit, and then amortization of low-income housing tax credit. When I first shared this slide with Dave, he said, okay, I can't make sense of this rate rec. Why is the benefit smaller than whatever that's hitting the rate? That's 1.5 million compared to 1.3 million benefit. So just a quick explanation. So this is an item that's not really specified under the standards. So the entity that has this kind of item will need to use the judgment to group the items. So low-income housing credit is something that an entity would invest into the low-income housing projects as a partnership equity investment. And then through the K1, this entity received the low-income housing tax credit to claim on the return. And then there's also tax benefits, let's say depreciation or losses. Those are coming through, but we are not seeing it quite here yet. And then amortization. So under the proportional amortization method, the entity would amortize the investment, and then the amortization expense directly hits the tax expense. So that's what you're seeing here. And then so in this presentation, you can't quite see, hey, is this actually generating a tax benefit or not? But again, this was grouped this way in this example. Another thing you can see here is the R&D tax credit of $200,000. That's a gross amount. And then there's another category item that says change in unrecognized tax benefits. That's actually an initial recognition of the uncertainty associated with the R&D credit. Like Dave and Tim mentioned, that this item, the initial current recognition, can be presented net with the position that it relates to. So we're looking at this example now, but in the next slide, we are going to show how different policies going to impact the presentation of the same rate reconciliation. So in this slide, we're showing the R&D tax credit being presented net of the initial recognition of the UTB. Also now, the low-income housing tax credit investment is all net together, the three different items, tax credit, amortization, and then the additional tax benefits are all net together and shown as other. So now it's showing the tax benefit instead of three different items presented in different category. So you can choose to present items a different way. And then so you're going to need to think about, okay, what would tell the best story that our company has? But I also wanted to mention that if it's not otherwise evident, you're going to have to add additional disclosures and talk about what's comprising that one line item potentially. And then under specific this specific example, you're going to probably have to disclose the gross tax benefit, as well as the amortization amount somewhere else under different guidance as well. So, as you're walking through the modeling and then kind of thinking about how you want to present certain items, really think about what additional disclosure you're going to have to make on top of this, just putting together the rate reconciliation.
Naomi, in interest of time, let's move to the next example because we've got 10 minutes left.
Yes. So this is a multinational entity example. And so what we wanted to illustrate here is, again, like additional categories coming through. As Tim mentioned, you would see the effective cross-tax border item, and then foreign tax credit associated with it. In this example, we're showing gross, but you have an option to net these items together. And then the valuation allowance here is associated with the domestic federal. And then so you would see under the foreign tax effects category, we are disaggregating different jurisdictions. And then one of the jurisdictions happened to have a change in valuation allowance associated with that jurisdiction showing up separately. And then also under the unrecognized tax benefit line, it encompassed the worldwide amount. And so those are the things that you could expect in the multinational effective tax rate reconciliation. So the next slide is just going to show what kind of information went into that rate reconciliation, but we're going to kind of skip this slide and go to the next item because we have a lot of participants from the private entities. And so in this example, we wanted to illustrate how hard it could be for private entities to describe all that going on verbally. So, you don't have to utilize a tabular reconciliation, as we mentioned, but you still need to talk about the nature and effect of specific categories that we've been talking about throughout this presentation, and then individual jurisdictions. So I believe nobody has tried this yet, so I wrote this whole thing and then got Dave's input on this. This is the kind of minimum kind of disclosure under the standard. But as you can see, the multinational example only had a few jurisdictions that's broken out. But if you happen to have smaller pre-tax net income for the year, and then if everything is hitting the rate goes over 1.05%, potentially there's going to be a whole lot more disclosures that might have to be made verbally. So consider, even if you're a private entity, maybe it is easier to show what's going on within your organization utilizing the table than writing this whole thing out.
Mm-hmm.
So we're gonna look at income taxes paid table. As I mentioned at the beginning of the presentation, this was a one-line item in the statement of cash flows. This expands the disclosures. So what I've seen in early adopters footnote is that some entities added this table to the income tax footnote and keeping the statement of cash flows intact. But we also think expanding the statement of cash flows disclosure will meet the requirement. So I don't know, what entities will end up doing because we haven't seen too many examples at this point. There weren't a lot of early adopters of the standard, but that's one way to meet the requirements. And then as Dave mentioned, if in the current year, a certain jurisdiction exceeded the 5% threshold, but not in the prior years, you could potentially do stuff like this, adding an asterisk and say, hey, the amount of the income taxes paid during that period didn't meet the 5% disaggregation threshold. All right, let's do the final polling question. Okay, how are you feeling about your organization's readiness to adopt this standard? A, we have already adopted and then we're good to go. And B, we're ready for the first year and with this standard. C, we thought we were ready, but there is still more to think about. D, we need help, I'm lost. E, other. So I hope there's not a whole lot of D's. But
and once we get through these questions too, we should address some of these, or once we get through the polling question, we should address some of the Q&A.
Absolutely, yes.
Yeah.
Okay, so we're gonna give you a few more seconds, maybe 30 more seconds. So to get CPE credit, you're gonna need to answer at least 3 out of 4. So please get your answer in. So for 71% answered the question. So we're going to give it another few more seconds.
Yeah. Hopefully we get above 80%.
Yeah, I hope so. But, as we were talking about all these stuff, we're hoping that we provided enough information for your organization to really think, and then how do we want to apply this? So I'm hoping to see answers. Okay. I think we're going to show the polling result. Awesome. This is great. I think, this is a time to think about how to do these things, and you still have time to implement this. So hopefully we provided some information for you to think about. All right. So now Tim is going to talk about how we can accomplish this.
And then we'll leave some time for answering the Q&A after.
Yeah, and thanks, Mayumi, for that. I think that the key here to prepare is just to one, make sure you have the right data. So that's a huge part of it. Do you have the data by jurisdiction? Do you have the data by entity? That would be sort of the first gating question I think you should all address as you're kind of thinking through whether you're ready to adopt this standard or not, because you're going to need to look at it at a pretty granular level. By jurisdiction, again, by entity. Also, do you have the right controls in place? Is your control framework designed properly to accommodate, the different elections and questions that need to be addressed as you work through this? If you're using a software, is your software capable? Can it, is it able to basically disclose these items? Of course, software is always kind of, it depends on the data, right? So if you're putting in bad data, it doesn't really matter, of course, how good the software is if the data is no good. And then, have you gone through all the relevant communications, right? Have you talked to your C-suite? Have you talked to the different stakeholders involved in the financial statement so they're aware of what needs to be disclosed and what needs to go in there? Have you spoken with your auditor? Do you know the plan for how you're going to adopt this new standard? Those are all sort of the relevant communications you'd want to go through as you work through this.
Okay. So we need to prepare for the changes as we've been talking, and it's really important to start this process now. Test your 2023 and 2024 data by reformatting your income tax footnote in accordance with the new ASU to see what it looks like and to plan for your policy elections. Look at your state taxes and look at and see, how are you currently calculating? Are you calculating on a state-by-state jurisdictional basis, which would be the best way to be able to determine, the new breakouts required for the states that make up 50%? Or is there a way, in the way your calculations are done on a more of a composite basis, that you'd have the ability to come up with a reasonable breakdown of your state taxes? Look at the different policy elections, draft disclosures for 2025 based on the interim period. We're halfway through the year, more than halfway through the year, and you could look at your disclosures, draft them, present them to your audit committee, to your C-suite, as well as your auditors, to start to circulate comments on how those disclosures are looking. Review them with management, the audit committee, and the auditors. Discuss with the auditors, your internal teams, and again, consider the time and effort that this is going to take, both in terms of internal time, external advisors, and internal costs and external fees, and whether or not, from a technology viewpoint, you'll be spending additional dollars for the requisite technology. So with that said, I think we're going to now open it up for questions.
Yeah, I think there are a couple questions that we can probably get to, maybe one, now that we only have 20 seconds. How about this question? If your state tax is larger than 5%, then I'm understanding correctly that you need to further break the state tax down by each state that is more than 50%, or
Yes.
get the question? Yep.
Yep. So state is always, no matter how small it is, state needs to be broken out because it's one of those 8 categories. And then within that category, provide the state that makes up more than 50%.
Yeah, just to be clear, that won't be disclosed within the tabular rate, right? That's a qualitative disclosure.
Yeah, that's a qualitative
Separately,
disclosure.
yeah.
Right.
Yeah.
But the state line should always be there, even if it's less than 5%.
Yep, and I think you're gonna just disclose what's making up the 50% state, but then that doesn't, it's gonna show each state that's making up the 50% category, but that doesn't necessarily show up in a rate rec.
Yeah.
Someone asked about software, and we haven't mentioned, but Baker Tilly, we have our historic income tax template that is now compliant with ASU 2309. So if you're working with us at Baker Tilly, our income tax template has been tested and fully functional as far as adoption of 2309. And we're aware of OneSource having a product that's ready to go, that's ASC 2309 component compliant, and then as well Bloomberg, I believe, is coming close to releasing their version of the 2309.
Yeah. And here at Baker Tilly, we're familiar with all those softwares, so we can help with any of them as they come up. I saw another question that came up: how does ASU 2023-09 impact S corps? So this standard does apply to all entities, although for an S corp you'd be working within the non-public entity disclosure aspect. So really, again, I think the key there is just, to the extent there's material items to disclose, is what you'd be looking for. But I wouldn't expect there to be much in the way of taxes for an S corp, perhaps state taxes and the like.
All right. I think we are just about out of time. We're a couple minutes over. Thank you so much, Mayumi, Dave, and Tim, for a great presentation today. We did have some questions come in kind of at the top of the hour here. And if we didn't have time to answer your question, we'll be doing our best to follow up with you after the webcast. You can also reach out directly to any of our presenters in the speaker bio widget. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Please also visit MossAdams.com for future webcasts and other resources to help elevate your performance upward. Thank you for joining us, and we hope you'll join us again next time.
Thank you.
Thank you, everybody.